Let's get you ready for the math you'll need to pass the Safe Mortgage Loan Originator exam. In this video, we'll cover the essential calculations you're most likely to see on the test, like loan-to-value ratios, discount points, and interest and monthly payments. These questions aren't just about formulas. They're about understanding how to apply them under pressure. And don't forget to watch the bottom corner. There's something there that could give your study session a serious boost. Let's dive in.
Let's begin with a review of mortgage math essentials, starting with basic math and financial calculations. If a borrower takes out a mortgage loan of $150,000 at an annual interest rate of 4% for 30 years, what is the total interest paid over the life of the loan? Is it A, $90,000, B, $120,000 and 0 cents, C, $107,804 and 40 cents, or D, $150,000 and 0 cents? The answer is C, $107,804 and 40 cents. The total interest paid over the life of a loan can be calculated using the formula: total interest equals monthly payment times number of payments minus principal. In this case, it is $107,804 and 40 cents. What is the monthly payment on a 15-year mortgage of $200,000 with an annual interest rate of 3%? Is it A, $1,200, B, $1,381.16, C, $1,500, or D, $1,700? The answer is B, $1,381.16. The monthly payment is calculated using the formula M equals P times R times 1 plus R to the power of N divided by 1 plus R to the power of N minus 1. For this example, the monthly payment is approximately $1,381.16.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsey.ai for immediate help and a free study session with Birdsey, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
How much principal is paid in the first month of a 30-year, $250,000 mortgage at 5% annual interest? Is it A, $343.86, B, $416.67, C, $1,342.05, or D, $500? The answer is A, $343.86. In the first month, the principal portion is calculated by subtracting the interest from the total monthly payment. Here, the principal payment is approximately $343.86. Which of the following is the correct formula for calculating the monthly mortgage payment? Is it A, MSEN, B, M equals P times R times N divided by 12, C, M equals P times R times 1 plus R to the power of N divided by 1 plus R to the power of N minus 1, or D, even and 4? The answer is C, M equals P times R times 1 plus R to the power of N divided by 1 plus R to the power of N minus 1. The correct formula is M equals P times R times 1 plus R to the power of N divided by 1 plus R to the power of N minus 1, where M is the monthly payment, P is the principal, R is the monthly interest rate, and N is the number of payments. If a borrower wants to pay off their 30-year mortgage in 20 years instead, what effect does this have on their monthly payments? Is it A, monthly payments decrease, B, monthly payments remain the same, C, monthly payments are slightly reduced, or D, monthly payments increase? The answer is D, monthly payments increase. Paying off a mortgage faster increases monthly payments because the same principal must be paid in fewer installments, reducing the total interest paid over the loan's life. Converting interest rates in terms. If a mortgage has an annual interest rate of 5%, what is the equivalent monthly interest rate if compounded monthly? Is it A, the interest rate would be 0.45%, B, the interest rate would be 0.4167%, C, the interest rate would be 0.5%, or D, the interest rate would be 0.4%? The answer is B, the interest rate would be 0.4167%. The monthly interest rate is found by dividing the annual rate by 12. For a 5% annual rate, the monthly rate is 5% divided by 12, which equals 0.4167%. What is the effective annual rate if the nominal rate is 6% compounded quarterly? Is it A, the effective annual rate would be 6%, B, the effective annual rate would be 6.25%, C, the effective annual rate would be 6.136%, or D, the effective annual rate would be 6.5%? The answer is C, the effective annual rate would be 6.136%. The effective annual rate is calculated as 1 plus 0.06 divided by 4 to the power of 4 minus 1, which equals 6.136%. Quarterly compounding increases the effective rate due to interest on interest. How would you convert a 10-year mortgage term into monthly payments? Is it A, 120 months, B, 100 months, C, 144 months, or D, 96 months? The answer is A, 120 months. To convert years into months, multiply by 12. A 10-year mortgage term is 10 times 12 equals 120 months. A mortgage has a semi-annual interest rate of 3%. What is the nominal annual interest rate? Is it A, the nominal annual interest rate would be 3%, B, the nominal annual interest rate would be 4.5%, C, the nominal annual interest rate would be 5%, or D, the nominal annual interest rate would be 6%? The answer is D. The nominal annual interest rate would be 6%. The nominal annual interest rate is twice the semi-annual rate. Therefore, 3% semi-annually results in a 6% nominal annual rate. If a loan has a nominal interest rate of 8% compounded monthly, what is the monthly interest rate? Is it A, the monthly interest rate would be 0.75%, B, the monthly interest rate would be 0.6667%, C, the monthly interest rate would be 0.8%, or D, the monthly interest rate would be 0.6%? The answer is B. The monthly interest rate would be 0.6667%. The monthly interest rate is the nominal rate divided by 12. Thus, 8% annually results in 0.6667% monthly.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
Loan-to-value, combined LTV, and high LTV calculations. What is the loan-to-value ratio if a borrower has a mortgage of $180,000 on a property valued at $240,000? Is it A, 70%, B, 70%, C, 80%, or D, 85%? The answer is B, 75%. LTV is calculated by dividing the mortgage amount by the property's appraised value. Here, $180,000 divided by $240,000 equals 0.75, or 75%. If a property is valued at $300,000 and the first mortgage is $200,000 with a second mortgage of $50,000, what is the combined loan-to-value ratio? Is it A, 66.67%, B, 70%, C, 83.33%, or D, 90%? The answer is C, 83.33%. CLTV is the sum of all loans divided by the property value. Here, $200,000 plus $50,000 equals $250,000 divided by $300,000 results in 83.33%. A borrower seeks a high LTV loan for a property appraised at $400,000. What is the maximum loan amount they can secure if the lender allows up to 95% LTV? Is it A, $350,000, B, $360,000, C, $370,000, or D, $380,000? The answer is D, $380,000. High LTV loans allow for larger loans relative to property value. Here, 95% of $400,000 equals $380,000, which is the maximum loan amount. In a scenario where a property is valued at $500,000, what is the LTV ratio if the borrower has a mortgage of $400,000? Is it A, 80%, B, 85%, C, 75%, or D, 90%? The answer is A, 80%. The LTV ratio is determined by dividing the mortgage by the property value. Here, $400,000 divided by $500,000 equals 0.80, or 80%. For a property valued at $600,000 with a first mortgage of $400,000 and a home equity line of credit of $60,000, what is the CLTV ratio? Is it A, 70%, B, 96.67%, C, 80%, or D, 85%? The answer is B, 76.67%. CLTV is the total of all loans divided by the property value. Here, $400,000 plus $60,000 equals $460,000 divided by $600,000 results in 76.67%. Debt-to-income ratios. What is the primary purpose of calculating a debt-to-income ratio for a mortgage applicant? Is it A, to determine the applicant's credit score, B, to evaluate the applicant's ability to manage monthly payments, C, to calculate the interest rate for the mortgage, or D, to establish the applicant's employment history? The answer is B, to evaluate the applicant's ability to manage monthly payments. The DTI ratio assesses a borrower's ability to manage monthly payments and repay debts. It helps lenders determine the risk of lending money based on the borrower's income and obligations. A borrower has a monthly gross income of $5,000 and monthly debt payments totaling $1,500. What is the borrower's DTI ratio? Is it A, 20%, B, 25%, C, 35%, or D, 30%? The answer is D, 30%. DTI ratio is calculated by dividing total monthly debt payments by gross monthly income. Here, $1,500 divided by $5,000 equals 0.30, or 30%. Which of the following is typically included in the calculation of a borrower's DTI ratio? Is it A, monthly car loan payments, B, grocery expenses, C, utility bills, or D, vacation savings? The answer is A, monthly car loan payments. Monthly debt obligations like car loans, student loans, and credit card payments are included in DTI calculations to assess financial burden. How does a high DTI ratio affect a mortgage application? Is it A, it increases the applicant's credit score, B, it guarantees approval for a mortgage, C, it may lead to loan denial or higher interest rates, or D, it has no impact on the mortgage application? The answer is C, it may lead to loan denial or higher interest rates. A high DTI ratio indicates a higher risk for lenders, suggesting the borrower may struggle to handle additional debt. It can lead to loan denial or higher interest rates. If a borrower's monthly debt obligations increase, what is the most likely impact on their DTI ratio? Is it A, the DTI ratio will increase, B, the DTI ratio will decrease, C, the DTI ratio will remain the same, Or D, the DTI ratio will become irrelevant? The answer is A, the DTI ratio will increase. An increase in monthly debt obligations, with income remaining constant, will raise the DTI ratio, indicating a higher percentage of income is used for debt payments.
Stuck on a question? Just think of the Birdsey link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Loan origination and qualification math. Qualifying income, hourly, salaried, commission-based. A borrower works 40 hours a week at $15 per hour. What is their monthly qualifying income? Is it A, $2,600, B, $2,400, C, $3,000, or D, $1,800? The answer is A, $2,600. To calculate monthly qualifying income, multiply the hourly wage by the number of hours worked weekly, then by 52 weeks, and divide by 12 months. This yields $2,600. A salaried employee earns $60,000 annually. What is their monthly qualifying income? Is it A, $4,800, B, $5,000, C, $5,200, or D, $4,500? The answer is B, $5,000. To determine monthly qualifying income for a salaried employee, divide the annual salary by 12. This yields $5,000. A commission-based employee has an average monthly commission of $4,000 over the past 12 months. What is their annual qualifying income? Is it A, $36,000, B, $42,000, C, $50,000, or D, $48,000? The answer is D, $48,000. For commission-based income, multiply the average monthly commission by 12 to find the annual qualifying income, resulting in $48,000. An employee receives a base salary of $30,000 and an annual bonus of $5,000. What is their monthly qualifying income? Is it A, $2,750, B, $3,000, C, $2,967, or D, $2,833? The answer is C, $2,967. Add the base salary and bonus, then divide by 12 to find the monthly income. $30,000 plus $5,000 divided by 12 equals $2,916.67. A borrower earns $20 per hour and works 30 hours per week. What is their annual qualifying income? Is it A, $28,800, B, $31, C, $32,000, or D, $30,000? The answer is B, $31,000. Multiply the hourly rate by hours per week, then by 52 weeks to determine annual income. $20 times 30 times 52 equals $31,200. Housing expense and total obligation ratios. A borrower has a monthly gross income of $5,000. If their housing expenses total $1,200, what is their housing expense ratio? Is it A, 20%, B, 24%, C, 30%, or D, 28%? The answer is B, 24%. The housing expense ratio is calculated by dividing the total housing expenses by the gross monthly income. In this case, $1,200 divided by $5,000 equals 0.24, or 24%. A borrower has a total monthly debt obligation of $1,800 and a gross monthly income of $6,000. What is their total obligation ratio? Is it A, 30%, B, 25%, C, 35%, or D, 40%? The answer is A, 30%. The total obligation ratio is calculated by dividing total monthly debt obligations by gross monthly income. Here, $1,800 divided by $6,000 equals 0.30, or 30%. If a borrower's housing expense ratio is 28% and their gross monthly income is $7,500, what is their monthly housing expense? Is it A, $1,800, B, $2,000, C, $2,100, or D, $2,400? The answer is C, $2,100. To find the monthly housing expense, multiply the housing expense ratio by the gross monthly income. 0.28 times $7,500 equals $2,100. A borrower has a monthly housing expense of $1,500 and other monthly debts of $500. If their gross monthly income is $5,000, what is their total obligation ratio? Is it A, 25%, B, 30%, C, 35%, or D, 40%? The answer is D, 40%. The total obligation ratio is calculated by dividing the sum of housing expenses and other debts by gross monthly income. $1,500 plus $500 divided by $5,000 equals 0.40 or 40%. A borrower earns $4,000 per month and has a housing expense of $1,200. They also have a car payment of $300 and a student loan payment of $200. What is their total obligation ratio? Is it A, 40%, B, 42.5%, C, 45%, or D, 50%? The answer is B, 42.5%. The total obligation ratio is the sum of all monthly debt payments divided by gross monthly income, $1,200 plus $300 plus $200 divided by $4,000 equals 0.425 or 42.5%. Down payment and cash to close calculations. If a borrower is purchasing a home for $300,000 and the lender requires a 20% down payment, what is the down payment amount? Is it A, $50,000, B, $55,000, C, $60,000, or D, $65,000? The answer is C, $60,000. The down payment is calculated as a percentage of the purchase price. For a 20% down payment on a $300,000 home, multiply $300,000 by 0.20, resulting in $60,000. A borrower has a cash-to-close requirement of $15,000. If their down payment is $12,000, what are their closing costs? Is it A, $3,000, B, $5,000, C, $8,000, or D, $10,000? The answer is A, $3,000. Cash to close includes both the down payment and closing costs. Subtract the down payment from the cash to close to find the closing costs. $15,000 minus $12,000 equals $3,000. A home buyer is purchasing a $250,000 home with a 15% down payment. What is the loan amount? Is it A, $200,000, B, $212,500, C, $225,000, or D, $237,500? The answer is B, $212,500. The loan amount is the purchase price minus the down payment. With a 15% down payment, calculate $250,000 times 0.15 equals $37,500. Then subtract from $250,000 to get $212,500. If a borrower needs to pay $18,000 cash to close and they already have $5,000 in earnest money, how much additional cash is required? Is it A, $5,000, B, $10,000, C, $12,000, or D, $13,000? The answer is D, $13,000. Cash to close is reduced by any earnest money already paid. Subtract the earnest money from the cash to close. $18,000 minus $5,000 equals $13,000 additional cash needed. A borrower is purchasing a $400,000 home with a 25% down payment. What is the cash to close if closing costs are $10,000? Is it A, $90,000, B, $100,000, C, $110,000, or D, $120,000? The answer is C, $110,000. Calculate the down payment. $400,000 times 0.25 equals $100,000. Add the closing costs to the down payment for cash to close. $100,000 plus $10,000 equals $110,000. Loan estimates and disclosure-related math. APR, annual percentage rate estimates. What is the primary purpose of the annual percentage rate in loan estimates? Is it A, to calculate monthly payments, B, to provide a comprehensive cost of borrowing, C, to determine eligibility for a loan, or D, to adjust the interest rate annually? The answer is B, to provide a comprehensive cost of borrowing. The APR provides a comprehensive measure of the cost of a loan, including interest and fees, expressed as an annual rate. It helps borrowers compare different loan offers effectively. How does the inclusion of closing costs impact the APR in a loan estimate? Is it A, it lowers the APR, B, it has no effect on the APR, C, it raises the APR, or D, it stabilizes the APR? The answer is C, it raises the APR. Closing costs increase the APR because they are added to the loan's total cost, reflecting in a higher annual percentage rate compared to the nominal interest rate alone. Which of the following is not included in the APR calculation for a mortgage loan? Is it A, interest rate, B, lender fees, C, closing costs, or D, escrow payments? The answer is D, escrow payments. The APR includes interest, lender fees, and certain closing costs, but it does not include escrow payments, which cover property taxes and insurance. If a borrower receives a loan estimate with an APR of 5.5% and an interest rate of 5%, what does the difference indicate? Is it A, additional costs like fees are included in the APR, B, the interest rate will increase to match the APR, C, the loan term is shorter than expected, or D, the interest rate is variable? The answer is A, additional costs like fees are included in the APR. The difference between the APR and the interest rate indicates the presence of additional costs, such as fees and closing costs, which are factored into the APR but not the interest rate. Why is it important for borrowers to understand the APR when comparing loan offers? Is it A, it reflects the true cost of borrowing, B, it shows the lowest possible interest rate, C, it determines the loan's repayment schedule, or D, it guarantees loan approval? The answer is A, it reflects the true cost of borrowing. Understanding the APR is crucial because it accounts for both the interest rate and additional costs, providing a clearer comparison of the true cost of different loan offers.
Don't forget to comment below with your tips, challenges, and thoughts on exam preparation. Your experiences can make a big difference for others.
Finance charges and prepaid costs. What is the purpose of the loan estimate form in mortgage transactions? Is it A, to finalize the loan agreement, B, to determine the borrower's creditworthiness, C, to provide a summary of loan terms and costs, or D, to serve as the final closing document? The answer is C, to provide a summary of loan terms and costs. The loan estimate form provides borrowers with an overview of loan terms, projected payments, and closing costs, allowing them to compare offers from different lenders and make informed decisions. Which of the following is considered a prepaid cost in a mortgage transaction? Is it A, origination fee, B, title insurance, C, appraisal fee, or D, homeowner's insurance? The answer is D, homeowners insurance. Prepaid costs are expenses paid at closing that cover future expenses, such as homeowners insurance, property taxes, and prepaid interest, which are necessary for establishing escrow accounts. How are finance charges calculated in a loan estimate? Is it A, including interest, origination fees, and service charges? B, including only the interest rate? C, including closing costs and property taxes? Or D, including title insurance and escrow deposits? The answer is A, including interest, origination fees, and service charges. Finance charges include all costs associated with obtaining credit, such as interest, origination fees, and service charges, but exclude items like title insurance and escrow deposits. Which of the following items is typically not included in the finance charge calculation? Is it A, origination fees, B, title insurance, C, loan processing fees, or D, interest charges? The answer is B, title insurance. Finance charges do not include fees for services required by the lender, but paid to third parties, such as title insurance, unless the lender retains a portion of the fee. What is the significance of the APR in a loan estimate? Is it A, it shows the monthly payment amount, B, it displays the total loan amount, C, it reflects the total cost of the loan, including fees, or D, it determines the loan term length? The answer is C, it reflects the total cost of the loan, including fees. The annual percentage rate reflects the true cost of borrowing by combining interest rates with other loan-related costs, allowing borrowers to compare different loans effectively. Aggregate escrow and prepaid interest. How is the initial escrow deposit calculated when preparing a loan estimate? Is it A, based only on the first month's payment, B, by estimating upcoming taxes and insurance premiums, C, by multiplying the monthly payment by 3, or D, using a fixed percentage of the loan amount? The answer is B, by estimating upcoming taxes and insurance premiums. The initial escrow deposit is calculated by estimating the amount needed to cover property taxes and insurance premiums due before the first payment and maintaining a cushion for future payments. What is the purpose of prepaid interest in a mortgage transaction? Is it A, to reduce the principal balance, B, to pay future interest in advance, C, to cover interest from closing to the first payment, or D, to decrease the monthly payment amount? The answer is C, to cover interest from closing to the first payment. Prepaid interest covers the interest due from the closing date until the first mortgage payment is due, ensuring the borrower pays interest for the exact number of days they have the loan. Which of the following best describes the aggregate adjustment in an escrow account? Is it A, adjustment to prevent excessive initial deposits, B, adjustment to increase monthly payments, C, adjustment for unexpected tax increases, or D, adjustment to lower interest rates? The answer is A, adjustment to prevent excessive initial deposits. The aggregate adjustment ensures that the initial escrow deposit is not excessive, aligning the escrow account balance with federal regulations and preventing overcharges. What is the maximum cushion allowed in an escrow account under RESPA regulations? Is it A, 1 month, B, 2 months, C, 3 months, or D, 4 months? The answer is B, 2 months. RESPA allows a maximum cushion of 2 months' worth of escrow payments to ensure there are enough funds to cover any unexpected increases in tax or insurance costs. How does the prepaid interest affect the closing costs on a loan estimate? Is it A, it reduces the closing costs, B, it is not included in closing costs, C, it has no impact on closing costs, or D, it increases the closing costs? The answer is D, it increases the closing costs. Prepaid interest is included in the closing costs and represents the interest for the days between the closing date and the start of the first full payment period.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit birdsey.ai for complimentary study sessions with Birdsey, your AI-powered study partner.